We have seen major differences between the current economy and what we had previously. Some industries are completely disrupted 1 year later, leading to obvious but yet to be announced bankruptcies of all kinds. Yet, looking at the stock market, you would think everything is simply fantastic. Even the stocks of the companies that may very well go bankrupt this year or potentially in the near future are doing quite well. It's truly a joke and not a funny one either. But as more people pour in, the euphoria takes over. What will stop the gravy train? You came here for the truth, so let me unveil that for you. Today we are going to talk about what's happening in the travel industry, going to talk about hotels. Of course, I'll have to mention the commercial mortgage-backed securities. We're going to look at how that relates to the market as a whole. I've got several charts to show you, a lot of detail. Let's get into it right away. Airbnb CEO says travel is never going back to the way it was before. I am interested to see how this progresses because, of course, for many different statistics, you look at it at the beginning of 2020, it was going in a certain direction, and then it fell off a cliff in the next few months after. And we saw that many of the stats actually did pick up from the bottom. Pretty much everything has. However, if you look in certain areas, there has been a clear distinction in between where it was, let's say, at that point and where we are today. You look at the factors which are really underlying all of this, and it seems to me that in certain industries, the hotel industry, anything to do with travel, anything to do with tourism as a whole is really taking a hit. That's why you're seeing a lot of these places, whether it's Hawaii, whether it's Caribbean, any of these places that really are heavily reliant on that tourism, they are going to have issues for the foreseeable future because they've lost all of this revenue. It's not as if there's this pent up demand where suddenly you're going to go on vacation 3 times a month because you missed all of that last year. It doesn't work like that. So right here, the CEO is basically just saying that there has been major change. Now, while the traditional way of traveling may have been disrupted, he even says in here that farm stays have been something that has picked up dramatically. So people are doing other things, and Airbnb had actually done quite well throughout this period. Further along, here it is, however, as lockdowns eased, more travelers opted to book homes instead of hotels, helping Airbnb post a surprise profit in the third quarter. That's interesting because people are simply going away from the big cities. He also talks about the fact that they wanted to see their families. They haven't been able to in a while. So they met at a place where it was just, let's say, a house, maybe in an area that isn't typically a big city, not going to the New Yorks and the San Franciscos and so on. They're going to the smaller cities doing things that they weren't before. And that could be a trend, not just with travel, but also the way that people are living. Because if this whole work from home thing becomes this new trend permanently, that could very well create a boom in some of those mid-tier and of course the tertiary cities that really didn't have that, let's say, infrastructure previously, that didn't have all the homes available. Now there might be a building boom, infrastructure boom as a result. But that leaves with, when you look at a city like New York, areas like Manhattan, other big cities that had so much infrastructure, maybe that isn't needed anymore. And from what I've told you previously, you could see a lot of these big buildings in these big cities, they are simply running on empty right now, and that just won't be filled up for a long period. Many of these businesses are trying to restrict how much real estate that they use because they may not own that building. They might be leasing a few floors from it, and if they're not paying the bills, who is going to deal with the lenders? Who's going to deal with those landlords in that case here? And that puts additional pressure on the industry as a whole. As I've mentioned many times before, you have the commercial mortgage-backed securities, the hotel industry really affected by that right now. And we could see that this is going to be potentially the linchpin when it comes to retail, office, and Anything else right now that's simply empty, you can't just fill that in overnight. So this is probably going to result in a lot of bankruptcies. There's going to be a whole bunch of mergers and acquisitions throughout this period, and as a result, jobs will be lost. But what is the solution to all of this? You could see right here in this image, the classic image, which they have photoshopped your friend and mine, Jerome Powell, on top of it. It's free money for everybody, right? Well, it looks like the average person gets a paycheck here or there once a year, and that's the stimulus. But ultimately, the banks, the financial industry, all of the big corporations, they are getting everything. When you look at the actual numbers, forget about what they tell you, forget about the suits and ties and what they try to convince you of. Look at the actual documented facts, and it is very clear that the mega corporations are definitely winning. Out of this Bloomberg article, they had this chart, something I've shown many times before, but it uses the new numbers. Wealth gap, the top 20% of earners own nearly all of the stocks held by US households. So you could see those two lines, which are clearly above the rest. That's the 80 to 99% and 99 to 100%. They have done very well. This chart goes back to 1989 up to the present, but it's very clear since the financial crisis that has been very distinct. And you look at those in the bottom 60% and it's gone nowhere. It has absolutely gone nowhere because if they don't own these different financial assets, they're not going to benefit from all the inflation that's been created by Jerome Powell and everybody before him. This is the way that it works today. Most people, they don't really realize the whole workings of the industry, but they simply know that debt in certain ways is not a good thing. If you see what's happening with the average credit card user, they know it's not good, but they're trapped in the cycle and it's very difficult to come up out of that. This is not necessarily what was happening previously. If you look, let's say 1970 and previous, that was a different story. But today we are definitely riding on fumes. And I use that to describe the debt scenario because it's all debt. It's not based in reality. Real wealth simply isn't there. And of course, this fictional world that we live in is never a good thing for the long-term growth. I'll talk about more in a second here. Looking smart. Retail favorite stocks are besting both the pros picks and the S&P 500. So people are simply getting into the big names, the names they know. They're looking at, it's the green line right here, just showing you that over this period right here from the March lows, people have been buying into the Teslas, the Apples, the Amazons, and so on. But if you take the market as a whole, which has done very well, there's no doubt about it, you compare that to the big names, and certainly those ones have risen up high. Now we'll see as we go into the next cycle what happens with that. We'll see if that trend continues. Fed's bazooka, mortgage rates plunged, and stocks rallied following the central bank's support. Everybody knows what happens right here when the Federal Reserve acts. You can see that the market is affected by it, whether we're looking at the bond market or not. The bond market is really where people need to simply keep an eye on. You don't need to know what every rate is on a given day, but you should definitely be checking on the trends. That's why I'm always touching on it. Yes, we do cover stocks. Yes, it's important to understand what's happening with the commercial mortgage-backed securities, but simply knowing the direction of what's happening in the bond market gives us insight as to how the underlying all of this is really operating. That's what I'm trying to point out. The euphoria is clearly in. I have a few charts here to show you from Real Investment Advice, this article that they put out. Just to give you some updates, let's run through it really quickly. Of course, to no surprise, the put-call ratio is back to a record that usually has preceded short-term corrections. Before I get into it, right underneath this part here, they mentioned the fact that they're starting to put hedges in. They're not into the profit taking yet, but they are looking at it, very cautious about what they're doing. Okay, so that's just what they say, not what I'm saying. You can visit the page If you're interested, the link will be in the description. But it just gives you some insight as to what's happening. Look at it down here, and every time it gets to this point, the put-call ratio usually indicates short-term correction. And right now we are in some serious froth. It's really, really, I don't want to say hot, it's going beyond that. And ultimately, this usually results in a little bit of a correction. Now, right now, as of January, things have been kind of up and down, really hasn't been as strong as it should, considering everything that's been happening. But ultimately, we'll see what goes on. I think there's a lot of caution right now over the next few days, as you know, there's big changes obviously happening. So we'll see what happens to the markets themselves. I think if that stimulus comes in, that's going to push the markets up higher, at least for those retail favorites. Markets disconnected from the economy, something that I show regularly, but this just puts three factors onto one chart. The cumulative S&P 500 growth 2007 up until the present has done very, very well, as you can see, and comparing that to the cumulative S&P sales growth. All right. And then, of course, the real GDP growth, which has been absolutely not in the same path. That's for sure. It just shows you, gives you some insight as to what happens here with all of the debt. The debt is really driving this. The problem with that is that debt is not real. It's created and conjured out of thin air. And so when we have corrections, they are aggressive on the way down, and a lot of people end up getting hurt by it. The other problem with debt is that we have this fun thing called derivatives. Now, derivatives created a huge mess back as we saw it during the financial crisis. And now today we've got a big mess, whether it's the commercial mortgage-backed securities and looking at all of the other derivatives that are in line with this. I mean, who knows what's going to happen all along the way. It doesn't really look good in this regard. Now, what that means for the markets as a whole, we don't know, because that has to unravel, and then we start to find out all that nasty business that's been going on. Looking at the market greed fear index, you could see what it's made up of here, just showing you right now at extreme greed, not surprising to anybody. This right here is the panic euphoria model. It's gone off the charts completely. Whether you want to look at this, time and time again, we see that there are always excesses, but nobody ever wants to believe it. They think that is somehow justified. Now, it doesn't tell you that the market's going to come down. It doesn't tell you what's going to happen to the market. It's just really, taking account of what's actually occurring. And clearly we are in that state today. You can measure it on basically any indicator, and it's gone off the charts. Again, doesn't mean that that's going to actually affect the markets. It's just giving you some insight. One last chart for this video today. Mobility trends, change in routing requests since January 13, 2020. And, obviously everybody knows what was going on here. Look at this during March. It just hits a bottom. But ever since then, whether we're looking at driving, walking, and transit, they have moved down from where we saw around that September, October timeframe, and have all started to come back down. This is interesting. I mean, obviously New York is one place that started to get the shutdowns, the lockdowns again happening. This just gives you some, insight as to what's happening in one big city, and you can understand how that really affects all of the different derivatives, all the businesses, all of those interlocking pieces that generally, as long as everything's moving, you wouldn't hear anything from it. But now, because it's gridlock, you've got an issue, and I don't think the Federal Reserve has any sort of solution that they can provide. That's the worrying part for the markets, which haven't yet to price that in. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you want to learn about e-commerce for free, I have an e-course to check out, the AmazonGPS.com. If you want to look at the financial system, you want to get into the details, but you want it explained extremely easily, check out my 2 books at the link in the description. And if you want the audiobook, that's available at themoneygps.com. Wait a second, hold on, don't go anywhere. Have you seen this video yet? If not, you definitely want to check it out. Click it, I'll see you there.